Ala, do you make any investments?
No, I don't think I have that kind of cash. I think it's expensive, right?
It doesn't. You don't have to invest cash. There are other things you could invest.
What, like time? Yeah. Well, I guess I'm investing time with my kids, except I'm not really sure what I'm hoping to get out of it, because that's the idea of investment, right? You put in something, and then out comes a lot more.
Oh, well, but you might not have to get something out of it for yourself. There, I believe you're investing in human capital. Your children are human capital. We'll find out about that term and some others in today's podcast. A Dictionary of Finance today is about investment. Today on A Dictionary of Finance from the European Investment Bank, we're going to look at investment. It's part of the European Investment Bank's name. We've already done banks, and I think people know what Europe is, so we should get to investment today. So we're joined by people who really know about this and have actually made a study, which we'll be talking about during the course of this, on investment. We've got Debora Revoltella, who is Director of the Economics Department at the European Investment Bank. And when you're not doing economics and running the models and all the things that economists do, what do you like to do?
I like very much traveling. It's something that I do a lot for work, but I also like very much doing it in private life, vacations or something.
Where do you like to go?
I traveled almost all over the world, I think.
Personally, I can't imagine why an Italian, and you are Italian, would ever leave Italy, but there we go. That's where everyone else likes to travel to, so I suppose the Italians have to go somewhere, don't they, on holiday? We've also got Koulev, who is Senior Economist in the Economic Studies Division of the Economics Department. Atanas, are you an economist?
Yes,
it sounds like it, doesn't it?
Yeah.
Right. But what do you do when you're not running the models and figuring out which way the economy is going?
Well, I have 3 kids, but in addition to that, I am the president of the EIB Karate Club. I've always wanted to do karate, but I only started 2 years ago.
So you're moderately frightening.
Indeed.
What's your favorite move?
My favorite move? This might be a kick, because kicks come a bit difficult for me, so I work a lot on them. So a side kick, or what the Japanese call yokogeri, is something that I've trained a lot. To the extent that I like it now.
Is that yokogeri? That's the noise someone makes when you kick them that way, right?
I guess so.
We've also got Philip Brocha. I guess you're an economist too. It says economist in the Economic Studies Division of the Economics Department. So you are an economist.
Yeah, that's my second function in a bank.
Oh, what's the first one?
Well, the first one is being the president of the EIB Football Club, of course.
Let's get on to the issue of investment. Deborah, what is investment and why do we need it?
So investment is the acquisition of goods that is used in the production of other goods and services. It's not consumed immediately, but is used for producing something else in the futures. And this is very important in the economy. It's one part of the economy, so we say it's one part of GDP creation, etc. But it's very important for the economy because it's allowed economists then to produce other goods going forward. And that's what we are studying. So we are trying to study what is happening to investment. We are trying to study what are the market failure, market gaps that lead to suboptimal provision of these goods. And then we are trying to study policies to support the provision of these goods.
But not all the things that companies and organizations spend money on, not all of that money is investment, right? So if I'm a company and I raise the salaries of the people who work for me, is that an investment?
No, not all money that are spent by companies is when you buy a good that is then used for the long term for producing other goods in the future.
But spending on people. If I hire new people, is that investment?
It's very tricky everything, because on the one side, if you invest in people, if you train your people, that is also investment, and that can be considered intangible investment. So something that is less tangible, but is still, you are investing on the skills of your people, and that create a good that is then used for producing other goods. And it's a complex point, but on the other side, if you pay your employees for the work they are currently doing, and it's just a remuneration of labor, and it's not.
You mentioned a couple of things there that I wanted if you could develop: market failure and market gap. What really is a market failure?
It's a market failure, as the word says, is when the market fails to deliver what would be optimal for the market. And
is that because of a lack of investment that you have a market failure?
In certain cases, lack of investment may be considered to be a market failure, but it's. What we consider is, and where policy is needed to address problems, is related to situations in which the market, by natural forces, doesn't account. One classical example is for externalities that one particular good may have, and if you leave it to market condition to regulate which is the optimal quantity of that good being produced in the market, you would end up with a suboptimal provision. So this is, I don't know, one cases could be on, what can it be
Well,
on?
industrial pollution can be a good example. It's the classical example of this kind of externality that results in market failure. If we take industrial fumes that a business produces when making a certain good, well, these are imposing cost on the environment, on the people living around, but this cost is not taken into account by the firm. So the firm would carry on its production generating this cost to everyone else without paying for it.
But with pollution, I understand that, you know, the government or that the public can assess that this company is polluting the environment this much, and to make up for it, they need to pay X amount, they need to make the investment or so forth. But in general, if we're talking about investment gaps, we're assuming that there is a normal level of investment, and that if there's a gap, then the companies or the European countries are falling below it. How do you guys define what is normal? What is a normal amount of investment? How much should companies be investing? What if maybe they shouldn't invest at all?
That is probably the most difficult question that is asked to economists, and economists especially in the economics department, but to compensate for that, it is being asked every day. Now, telling what the market gap or the investment gap is on this or that market is practically impossible.
So basically companies tell us that they would like to invest, but they can't because of different
This is
issues.
one way to quantify it. If you're able to go to a company and ask that company, as we actually did with the investment survey, do you consider your investment optimal or enough to keep you on the market or to be a successful businessman? Then we can get a certain measure of what the market gap is or investment gap is. Well, this is just a subjective measure from the perspective of that given business. So even that is not the ideal or kind of policy maker's view of what an investment gap is. That's why it's very difficult to quantify these things. And economists cannot say, well, we would confidently need 300 billion euros to fill in the investment gap in Europe.
One simple example, the European Union is giving itself targets on how much investment in research and development the European Union wants to have. We are below the targets, that's the gap. And these are indirect ways for defining the gap.
You know, why can a company not simply say, every year we invest €1 million, that's enough, that's the same every year? Why does it need to increase? Why does it go down? Why does it go up?
Well, the simple answer to this is effectively that the world doesn't stand still. So if you think about what a company looked like 50 years ago, and you thought about investment, you would think about spending on a building, you would think about spending on a vehicle maybe 30, 20 years ago. You would also think about maybe spending on a computer. Now think about a company today, the extreme case, think about Facebook. Think about what makes Facebook special. It's not the building, it's not the computers. I'm sure they have perfect computers there. It's really something completely different. It's things that cannot be touched. It's what Debora called earlier intangibles. So it's their brand name. It's of course the data that they are collecting. It's these kind of things. So what that example illustrates to you are two things. First of all, the business world changes dramatically. The way we go about the same tasks today is very different from the way we went about the same tasks 50 years ago. And that's a very, very good thing, because in general we became a lot better in doing these same tasks. And we became better in doing these same tasks because we invented new ways of going about them, and we had to invest in the infrastructure, in the capital, stock, and so on to do so. But that brings me to the second point. What we invest in also changes, right? At the beginning, we became better by investing in electrification. Now we become better in investing in smart people. We become better by investing in big data. So in a nutshell, this is, I think, why investment is important. It's to ensure that we keep on moving forward and we keep on becoming better at what we're doing and keep on supporting living standards of rising.
You've mentioned one term that I think is going to come up again and again. So before we move on, capital stock. We want to define that for our listeners. What's that?
The capital stock is basically the capital of a company. So the stuff that a company exists of. So, as I said, basically you might think of the building in the first instance, you might think of the machines a company has and so on, but increasingly also stuff that you can't touch. Ideas, data, software, and so on.
And the people who work for you, is that human capital? Is that what it's called?
Absolutely, that's what people would say, yes.
Everybody will be delighted to know that they are human capital. Atanas, you wanted to come in on the previous question.
At some point we have an investment boom. Everyone is investing in given assets. Then a stock market crash comes and, investment stops. Investment is a very volatile thing. And the reason why it is so is that it is very much related to uncertainty. If you are a business, you buy machines because you think demand for your produce will come. But then this is your estimate. Something else may happen, and then whatever you produce may not be very interesting for people, or you may end up in a bad economic situation where no one would like to buy luxury goods that you're producing, for instance. So because of this intrinsic uncertainty, whenever big common shocks happen, like a stock market crash or like a deep recession or financial crisis, all of a sudden this uncertainty hits on businesses at the same time, and they say, well, I'd rather not invest now. I take the time to see how things resolve, and once this is done, I start investing again. And this is what we had especially acute during the financial crisis, when investment fell so low and for so long.
So let's talk about where things are now. You've just completed this investment report that Debora was mentioning. What's the main finding of that? What's the thing that people should really know about?
I think the main finding is starts from the realization that investment is recovering. So we are in an economic recovery. We see investment recovery at the European level. So the question is, okay, that's it. Should we be happy and should we close the EIB? And our answer is no. No, because we look in depth at a number of areas in which we still think that there are issues in terms of the right amount of investment that is being placed if you look at the long-term consequence that this investment would have on the European economy. And we find actually 4 areas of concern where we think that policy action should be taken in order to support more investment going on. And the 4 areas are related to infrastructure investment, it's one. The second one is related to this concept that we are putting back on the table of intangible investment, but you can think about the competitiveness of the European economy and everything that goes around it. The third area of investment is related to access to finance and innovation of firms and the innovative capacity of firms and the business environment. And I think we had 5 at the end, climate action.
Infrastructure investment, why is that so important and why is it not high enough?
Well, infrastructure is important because it links our everyday lives.
What do we mean by infrastructure? Do we mean bridges and tunnels, or do we mean broadband cable? What is it exactly?
You have various types of infrastructure. You have what we would call economic infrastructure, which is exactly what you refer to: transport infrastructure, energy infrastructure, and also ICT infrastructure. But then there's a second category which we normally refer to as social infrastructure. So that would comprise education, for instance, or investment in health.
Why infrastructure is so important?
Yeah.
Now, most of infrastructure assets have a property that we call network externality. So most infrastructure assets are like networks. And this gives them more value than other similar assets, because infrastructure are typically buildings and structures. Both sports centers and shopping malls are as well buildings and structures. But they lack this network effect that infrastructure brings to us. The classical example about it is the telephone set. If only you in the world own the telephone set, then it may not be so valuable to you. But infrastructure assets like roads, like telecom cables, like power grids, they have this network effect. They give businesses the possibility to have more customers, to get access to cheaper resources, to find new practices that they didn't know about, business practices. So this increases this intrinsic value that a road would have, or a telecom cable would have. So this adds up and ends up to be a very important determinant of long-term growth. Actually, this enhances the economies to grow in the future.
Before we go on about the report a little further in detail, I wanted to pick up on something you said, Philip, which is about some of the kinds of investments in infrastructure you were talking about would be government investment. They wouldn't be private companies. So we're thinking about a slightly different kind of investment there. When there's an economic crash and the government cuts back its investment, why does it cut back its investment? Or I should say, why did governments cut back in the case of this last crash? Because they don't always, right?
No, exactly. It's not a necessity. In fact, you would hope that the government, normally, as Atanas was explaining, investment in infrastructure has a long-term value. It helps us to become more productive in the longer term and to become better at the things we do. But in the short term, of course, it has also a stabilizing effect, in particular during a crisis. It's additional spending. So if all the businesses lose their confidence at a moment and they draw back their spending, obviously that has huge implications, because if this is uncoordinated but happens at the same time, each one cuts their spending, that has magnifying effect. So often you can think of government spending in these situations as being stabilizing. It sort of buffers this negative effect. And the beauty of infrastructure in this investment in this context is, of course, that it's not wasted sort of stabilizing money, but it is actually very productive one. Now, what we've seen over the crisis is unfortunately the opposite. While initially governments increased their investment activities in infrastructure over the recent years, they've increasingly cut back. And it's a very interesting question to know why this is. Certainly, we've had the sovereign debt crisis at one point, which put a lot of pressure on governments to reduce their spending overall. If this may have led to a reduction in the size of the pie to be spent by the government, if you like, what we observe in the data is also that not only the pie overall became smaller, but also the slice of the overall pie of spending that goes to infrastructure has become smaller.
What happened is the saving on the interest payment part was going to current expenditures only, and the capital expenditure massively reduced. So in reality, you could have had in many countries more long-term growth-friendly policies that also look at the long-term consequence of the recomposition of expenditures. And that's what one of the messages that we have is that in Europe we should have a new narrative of the importance of infrastructure and put it back, reprioritize in political term in the narrative.
Mm-hmm. Well, you explained the gap in infrastructure spending and the gaps you found in the 4 other areas, but the overall kind of a positive feeling that I got from the report that it is picking up. What are some of the areas where Europe is doing better? Where are we doing well in terms of investment? Or are we just focused on the problems, what we're doing not enough of?
I think if I may, and then the other will pick up, I think where we are doing well is at the end corporate investment is recovering. That's a good news. The bad news associated, and we as economists, we may always have the bad side of the story, what you should worry about in mind. The bad news is that we have been underinvesting for so long, and others have been investing so much that the companies are still competing in a global market. And if your competitor have the best technology, the best investment, are attracting the best people, and they are training them in the best possible way, if you delayed it for long and you don't pick up quickly, there may be long-term consequences. So that's where we come from. We come from the scenario, the outlook is positive, the recovery is there, but we are telling move it fast, try to accelerate, to go quickly.
Also, Europe is not a homogeneous thing. We have countries that really excel in innovation, that are the top performers in the world. Like Sweden or Finland or Germany. But then, if we look at the whole union, there are also countries that are really at a rather low position as far as innovation is concerned.
Well, if you want to make an investment, you've got to have something to invest. You've got to have what you call in the economic phrase access to finance. And in your report, there seems to be some problems with that. Could you lay that out for us?
When it's about financing decisions, firms can really rely on different sources. There's, of course, internal sources. So basically the profits that they generate, they can reinvest them. They can use that cash. In some cases, some companies are also owned by bigger companies, so they can just ask the mother company for some credit. But a substantial part of investment is actually raised externally. Right? So you go to people you normally don't know and you ask them to lend you some money. And that's primarily in Europe banks. So we still see that in many countries that were hardest hit by the crisis, access to finance, in particular external finance, but also internal finance, generating sufficient profits to finance their investment activities is difficult. Right? If you're a business in, say, Greece, it's a lot harder to finance the same investment project than if you're a business in Austria. Say. So that's a mere result of the macroeconomic situation. Then a lot depends, of course, also on what your business does. right? Picking up on the idea earlier that also the structure of businesses changes. So if you're a business that relies heavily on machines, it may be much easier for you to get a loan from a bank, for instance, because you can say to the bank, look, if things go really bad, poorly, you can keep the machine, right? So it's basically an asset, a security. If you're a company like, say, Facebook again, even though Facebook doesn't necessarily have the kinds of problems we are talking about, but a company that invests highly in stuff that you can't touch and that the bank can't take afterwards, then it's much, much harder to get access to finance. So what we see is that access to finance is not only dependent on where you're based, but also what you do, meaning the kinds of assets that you're generating when you invest.
Is this why we get this statistic, which was quite striking to me in the report, that large firms are twice as likely, 2 times more likely to be innovators than small businesses? Because usually you think innovation comes from a guy in his garage coming up with an idea and then he goes out and turns it into Microsoft or something. But this suggests that actually big companies, which can get the money to invest more easily, therefore innovate.
Defining the causality is one of the most complex things in economics. So we don't go so far as saying what is the causality in the link. But what we definitely find out is that Europe has a much more large innovator rather than small innovators. And one of the things that is striking is that Europe lacks the kind of finance that allow the small firms to grow and to stay innovators over the whole chain of growth. In the US, in other parts of the world, you have much more of this. So at the end, you end up having the large firms being the real innovators and getting most of the innovation going on.
So the causality could be that if the smaller companies in Europe had better access to finance, the amount of innovation they could do could be actually much greater than they are doing right now.
Yeah.
In a sense, yes. The big failure in Europe is that these small innovative companies cannot make it to become large companies. So we have a lot of large innovators, but also large old innovators. We lack the Googles and the Amazons, because firms at a certain stage, once they introduce their product, they lack growth finance, but they're also subject to oftentimes a very stringent business environment in which they cannot progress. So this results in many European countries having too few young and leading innovators.
Well, we're about out of time here. You've invested a lot of your time in this podcast with us. If our listeners want to read the whole report, and it's, I guess it's quite chunky. So if you like tables and charts and things like that, and important economic insights, then you can go to eib.org and look for the investment report, and you'll see the work that Debora and Philip and Atanas have done in great depth. So thank you so much for explaining it to us today.
And the rest of the team.
And the rest of the team, of course. And if you want to get in touch with us on Twitter and tell us, hey, I read the investment report and it's fantastic, or anything else, you can contact me at EIBMatt, EIBMatt.
And I'm at $Tankler, ALLARTANKLER. And also tell us about future issues and terms that you would like to have defined on a Dictionary of Finance in the upcoming shows. And tune in again next week.